I like the company Vanguard, but I believe you can do a whole lot better. And no, I'm not talking about active management. I don't believe in that. I'll joke and say active management, paying those high fees, that's like going to Whole Foods and buying paper plates. You don't need to do that. But I'm going to walk you through how I often invest with my clients and the approach that I take and believe in. So these are just my thoughts. If you want to have a sustainable early retirement for 40, 50 plus years of income and optimize without leaving anything on the table. If you're looking for more guidance along investing, tax strategy, withdrawal, insurance, estate planning, that is what this channel is designed for. I want you to retire early with confidence. I don't want you to retire too early and run the risk of running out. And I don't want you to be mad at me when you're 75 with 10 million bucks going, why didn't you tell me I should have retired earlier? So I'm all about transparency and want to share my thoughts on investing in today's video. Hey guys, thanks as always for watching the content. I hope it resonates with you. This, please know, is not financial advice. Everything I do on this channel is for informational purposes only. Before you go execute any financial strategy that I'm discussing, please consult with a financial advisor, a tax professional, your legal professional. Please, please be smart about this. This is not financial advice, just for informational and educational purposes only. Now let's get back to the show. Now, first things first. I don't work for Vanguard, don't work for Fidelity, don't work for T. Rowe Price, don't work for Dimensional, don't work with Empower or Merrill Lynch. I do not care who you or my clients use to invest their money. I just care that you make the most money. Now, here's why I care and get passionate about this. My mom is a really nice lady, doesn't know a stock from a mutual fund, from a SMA to fixed income, that this is not her world, but she's like, Ari, trust me, Fidelity would never tell me I should have a different fund. They would just tell me the right fund I should own. I told them about my goals and my risk tolerance. I said, hey mom, totally get it. But there's a conference room. And in the conference room, there's a leaderboard. And when someone sells a certain amount of a certain investment, they're going to get to go on a cruise ship. So I'm not against people taking vacations, but I'm going to guess if you look at your Fidelity account, most of your money's at Fidelity. Not saying Fidelity's bad. I'm saying we want to make sure we're picking the right investments, not just because they're recommending that. My mom's like, they wouldn't do that, trust me. I said, okay, ask them. 100% of her money was in Fidelity. Now, luckily, some of the funds were okay, but others of them were not ideal, and they were paying fairly large commissions to that representative. So Fidelity, Vanguard, Empower, I don't care. I just want you to make the most money. So I will start my investment conversation with any client asking about what grocery store they go to. And I'll say, seriously, what grocery store? Now, sometimes I don't know it because it's a small, shop in the Northwest. But other times they're like, no, I go to Kroger, or I go to Whole Foods, or I go to the dollar store. I'm like, that's cool. Why don't you just only go to Whole Foods? Buy everything there. I mean, paper plates and, everything. They're like, yeah, I don't know. I think I'd be overcharged. Like, I don't think I need to buy paper plates there. I go, I agree. I go, do you go there for anything? And some people go, yeah, I'll go there for salmon or steak or whatever. I go, that's cool. I'll say, why don't you, okay, if that's too much, why don't you just go to the dollar store for everything? And they're like, I just don't feel it's the best value. Like, I don't want a steak from the dollar store. Maybe paper plates are okay, but steak, that doesn't sound right. I'll go, okay, well, what about Trader Joe's? And you'll go, maybe I go there. Trader Joe's, Kroger, Vaughn's, or Albertsons. Now, I know I'm missing out on a lot of grocery stores, okay? So feel free for fun to make fun of me and go in the comments and tell me your favorite grocery store. But the example is simple, but it's the reason I do these little silly stories, it makes people actually resonate with it and get their brains thinking. So I'll say the approach I take is not, it needs to be only Whole Foods or only dollar store or only Kroger. It should be a dynamic approach. And the point here is active management, historically, the high fees, it's not worth it. Now, most people that come to me either have, I'll call it 15% of people have active management, and let's say the other 85% have Vanguard or index funds. I go, look, index funds are good. I'm not hating on index funds. Warren Buffett said if anything happened to him, he would put his money into index funds in the S&P 500. I'd probably do the same because my friends and family, they're not going to want to manage investments, and you can't go wrong. I mean, look how well the S&P 500 has done, but it doesn't go deep enough, and I'm going to explain why. So let's assume, just take a hypothetical. I'm going to call you John. Obviously, I'm Ari. John, let's pretend you're the most disciplined investor of all time. Markets go up, markets go down, doesn't faze you. You're disciplined, okay? But I'm not disciplined. And when markets go down, I get scared and I want to sell because markets are down. I'm like, I don't like this feeling. So I go click sell. Now, when I click sell, the S&P 500 index fund manager at Vanguard, his job isn't very fun. He just has to do what I say, which is buy or sell. So I click sell. He has to give me my money. I'm like, oh, thank God. Markets were going down. I'm so scared. Now, John over here, which is you, John's like, wait a second. This doesn't sound fair. Just because Ari's stupid and he's not disciplined when markets go down, why am I being negatively impacted by that? So what's happening is John is a disciplined investor. That's you. I'm an undisciplined investor. When you're at Vanguard, Vanguard is good, but it's like the dollar store. You're going to eat. You're going to be okay. If you chose Vanguard, you'd be fine. But you wouldn't be doing as good as you possibly could because you're alongside every investor, and so you're not getting the best price. And that's what it comes down to, is an advisor wants to make sure you're optimizing. If you're just with Vanguard, which is not bad, but a lot of people are coming to me from Vanguard because Vanguard does a good job with, hey, should I rebalance, and giving me some basic guidance. But it's not like they're not going to tell you should do Roth conversions or which withdrawal strategy to optimize and how health insurance should get in. Like, they're not going to do that. They're just going to do the investing side. So I have a few investment clients that go, Ari, I shop at the dollar store, and that's me. I'm super frugal. I love it. I go, cool, Vanguard might be great for you. Other people are like, no, I get what you're saying, but tell me more. And I'll say, okay. So I like to bring up independent studies because I want to make sure people know I don't get paid more. I could care less if you use Dimensional or Vanguard. But you can see here's an independent study done last year by Sam Instone. He's my best friend. Just kidding. Don't know who Sam is. But you can see he says, what's better, Dimensional or Vanguard? And here's the short answer. Both are great. They're both better than 99% of what's out there. They both have strengths and weaknesses, and they're better than 99% of investors, okay? So like whichever one you pick, it's going to be good. But you can see here, dimensional funds goes deeper. And there's a few unique approaches that I'm going to explain. And you can see when we talk about returns and how all of this fancy stuff works, generally, you can see the verdict is you pick either, you're going to be well. Traditionally, dimensional funds has done better, which is why I recommend dimensional funds. Now, let me give you a better example. Have you, John, hypothetically, ever bought roses for your wife, Jane? And John will be like, yeah, I have. And I'll say, well, would it be better for you to buy roses in the summer or the day before Valentine's Day? Meaning, what price would be better? Now, one person came to me when I did this example. They're like, Ari, I'm a florist, and it's unrealistic. The roses are going to stay well from June until February. I'm like, give me a break, all right? I'm not saying the roses are going to stay well. Just trying to give you an example. So obviously, the price is going to be way more if you buy roses the day before Valentine's Day versus in the summer. Well, Vanguard, the S&P 500 manager, they don't get to buy roses in the summer. They just have to wait for companies like Tesla, for example, to grow and grow and grow and grow. And then eventually it hits what's called a market cap, and they have to go buy it. So they are buying Tesla the day before Valentine's Day with everyone else. So are they still buying a good company? Yes. Are they buying it at the best possible price? No. Dimensional funds is like, look, we don't believe in active management. High fees? Nope, don't believe in that. Doesn't add value. But we do believe that if Tesla's growing like crazy and we're not blind here and we see it's growing like crazy, why would we not buy it in the summer? I mean, this is a no-brainer, and that would mean there's a lot more value. So dimensional funds, they on purpose do not want to go advertise during the Super Bowl at halftime. Because if everyone bought dimensional funds, they would become just like Vanguard tomorrow. They only work with advisors. They were exclusive to advisors. Now, if you're an educated investor, you can look up their ETFs and you can purchase them. So they're available to you right now. Dimensional funds work with advisors that educate clients, pension funds, and endowments. They're the 5th largest asset manager in the world. Once again, I don't get paid by them. Could care less if you use them or don't use them. Just want you to optimize. Let me show you a better example. Here's another independent study. This was done 10 years ago, so you know I'm not cherry picking anything. And you can see Dimensional versus Vanguard. They're great. They're both awesome. But if you want to really understand how investing at the next level really occurs, if you just said, I want to have the S&P 500, well, I might tell a client, look at the difference of dimensional versus Vanguard. But if you start looking at some of these other asset classes and how investments get created, what you really want to understand is if you're a disciplined investor, dimensional funds might be better for you. If you're like, no, I'm more of just laid back, don't want to watch money, care less what happens, want super low cost, I want to eat, but like I don't need Kroger or the Whole Foods, Vanguard might be great for you. So I have clients at Vanguard. I don't hate Vanguard. I like Vanguard. I was at Vanguard 4 years ago for my entire career until I realized that I thought there was an approach that was better. So on my screen here, on the Dimensional website, they have one video. It's called You Can Do Better Than Indexing. Well, they have way more videos. But what I like, Dimensional focuses what you can see when it comes to a flexible approach. You can learn a lot more about that in this video here. It's also on YouTube. So if you just search You Can Do Better Than Indexing YouTube, you'll see it's going to pop up right here on Dimensional's YouTube channel, and you can learn all about it. Don't worry about this financial ad right here, but you can just skip. It's a 4-minute video, and you can learn all about dimensional funds and what makes them truly different. So you can see dimensional funds. When anyone's asking me, hey, just give me like the 1-minute breakdown. What's the deal with this company? Well, not this one pager. I have lots of one pagers. Let me pull this one up for you. Dimensional, here's their philosophy. Is they go, there's 3 types of investing. There's people that try to pick stocks. There's people that just have index funds. And you can see the little bullet points with each. So stock picking, you want to try to beat the market? Good luck. I don't really believe in that. Indexing is good. You can track the market. It's pretty cool. But there's limited flexibility since you don't get to choose. You don't get to choose when someone buys or sells. It can result in lower returns and higher trading costs. Long periods between index reconstitutions can lead to style drift. What on earth does that mean? I think that's just something they made up to sound smart. Just kidding. What that means is similar to the Tesla example, is the S&P 500 index fund manager doesn't get to choose when anything happens. They just have to follow general guidelines. And then there's dimensional. They trust market prices, they rely on them, and they're essentially using financial science in an internal team to optimize. So here's their one sentence. Dimensional strategies are diversified, low cost, like most passive strategies, but they go beyond indexing and it's not active management. So if you're like, hey, this sounds interesting, I've never heard about this, and you want to learn more, well, go to their YouTube channel. I don't get paid by them, so I don't care if you watch their videos or don't watch. My job is to tell you about things you otherwise couldn't have known, and this is because I want you to have the most income over the rest of your life. Now, with this being said, I'm going to tell you one thing that's way more important than anything I discussed today. Whether you use Fidelity or Dimensional or Vanguard or Empower or Merrill Lynch or whoever, whether you use any of those companies does not come anywhere close to the importance of determining your asset allocation. How much should you have in stocks versus bonds? So if you're like, Ari, I think I'm going to do 70-30, 70% equities, 30% fixed income, and I like this dimensional thing, and I'm just going to trust you on this, that they're better. I'll say, I would rather you don't do that and have 80% equities and 20% Vanguard fixed income, because you already are at Vanguard, you already like Vanguard, you already understand Vanguard. Dimensional, maybe you want to do it in the future after you do more research for years, and maybe you do that in the future once again, but asset allocation is more important than which investment company you use. And what, do you use a Roth or a 401k? Asset allocation, how much is in equities versus fixed income, that is the single biggest thing that's going to dictate your retirement, like volatility, income, success. So yes, I'm talking about more nuance today, but if you want to understand more, I would consider you to join the Early Retirement Academy, where I talk in depth about asset allocation and how to think through this in greater detail. If you want my latest video on asset allocation, click this right here and you can go ahead and watch that right now. If you're looking for a holistic financial strategy, make sure to reach out to us here at Root if this sounds like the approach you're looking for. Next level guidance for investing, tax, withdrawal, estate, insurance, so that you optimize your retirement.